Chapter 9 covers tax depreciation. I believe you're familiar with the concept of depreciation from your financial accounting courses. This presentation is going to talk specifically about how we deal with depreciation on the tax return, and as I go through the presentation, you'll see that how we deal with depreciation on the tax return is oftentimes different than how you calculate depreciation for financial accounting purposes or pursuant to GAAP. Okay, so what you've learned in financial accounting, we're gonna switch it up, and the treatment's going to be different when we talk about how taxpayers treat depreciation on their tax return. Okay, so in general, what is depreciation? If a taxpayer purchases an asset and they expect that that asset is going to provide a benefit for more than a year, then instead of the taxpayer taking an immediate deduction for the entire cost of the asset in the year of purchase, that taxpayer, because the asset's going to provide a benefit for more than a year, that taxpayer has to capitalize the cost of the asset, okay, record it first on the balance sheet, and then take deductions for the cost of that asset, depreciation deductions, over the life of that asset, okay? So there's lots of things we're going to have to depreciate on the tax return, okay? You can think of a lot of assets that provide a benefit for that's longer than a year. Buildings, equipment, machinery, furniture, software, okay? So those are the types of things we're talking about here, okay? A taxpayer needs these types of assets. They go and buy it. Instead of taking a deduction for the entire purchase price in the year of purchase, we're spreading out that cost over a number of years, okay? So a couple of things for tax. For when we're dealing with tangible property, okay, anything that's not a land or building, and when we talk about real property, okay, when we talk about buildings, then as we go through this calculation, as we capitalize the cost and take deductions over time, we're going to call this depreciation. In another presentation, I'll talk about amortization. Amortization is taking deductions for the cost of intangible assets that provide a benefit for more than a year. Intangible assets are like copyrights or patents or a covenant not to compete. So a business could have many assets that are very valuable that have no physical substance. We're going to call those intangible assets, and we're going to recover the cost of those assets through amortization expenses. And then finally, we'll talk about depletion. And depletion is how taxpayers recover the cost of extracting natural resources, so mining, forestry, and we'll talk a little bit about that, okay? So in general, if the asset's going to provide a benefit for more than a year, we have to capitalize the cost and take the deductions over time. What we call those deductions is going to depend on the nature of the asset, either depreciation, amortization, or depletion, okay? So just kind of keep in mind that this depreciation stuff is not ideal for taxpayers. So our objective when we're filing the tax return is to try to the extent of the tax law, minimize a taxpayer's taxable income, okay? And one way we can do that is by accelerating deductions, okay? We talked about that last semester. What's good tax planning? Oftentimes, good tax planning involves accelerating deductions into the current year. And so that's and depreciation is going against that, right? What depreciation rules are going to force us to do is instead of taking a deduction in the current year, we're going to have to wait and take the deduction next year and the year after that, okay? So just kind of keep that in mind. And then finally, this might be obvious, but all we're doing with depreciation is we're taking the total cost of the asset and we're deducting that total cost of the asset, but over a number of years. So at the end of the asset's recovery period or the asset's useful life, the taxpayer will have received a tax deduction equal to the total cost, the total purchase price of the asset, but instead of taking it in the current year, we have to spread it out over time. But in the end, our total depreciation deductions is going to equal the total cost of the asset. Okay, so keep that in mind. So oftentimes, it's pretty easy to decide if we have to capitalize something or if we can go ahead and take an immediate deduction for it. Okay, usually it's obvious if something is going to provide a benefit for more than a year or not. Sometimes it's not as obvious, and this slide just talks about what happens when it's not as obvious. And so two examples of when it might not be obvious are repairs and maintenance expenses, big repairs and maintenance expenses, and then if we have a client that has to engage in some environmental cleanup, okay, then if we have these kind of significant types of cleanup or repair expenses, then it might not be clear whether we can take the deduction as they're incurred or whether we have to create an asset and spread that deduction out over time. Okay, so what we're going to do, and if it's not clear, is the decision rule that we're going to follow is if the expense is something routine. Okay, if we're simply bringing the asset back to its original condition or maintaining the asset's original condition, then we can take an immediate deduction. Okay, we can deduct the cost as it's incurred. And so the example I have on here is getting an oil change for a company truck. Okay, the oil change is something routine in nature. We're simply keeping the truck operational, and so the cost of that, we can take an immediate deduction for it. Now, if we look at an expense that's bigger in scale, okay, a more significant repair expense, then we need to look at whether that expense is improving the asset, if it's extending the life of the asset, if it's increasing the value of the asset, if it's preparing the asset for a different use. If it's doing any of these things, if the expense that we've incurred is doing any of those things, then instead of taking an immediate deduction for that expense, we have to capitalize the amount of that expense, create a new asset, and then recover the cost of that asset via depreciation expenses. Okay, so that's the decision rule that we want to follow. So the second type, whether it's improving or extending the life of the asset, we can think of replacing the engine in a company truck. Okay, we replace the entire engine. Now we're increasing the value of the truck. We're extending the useful life. Maybe we're doubling the useful life of that truck. And so in that example, if we're replacing the engine, then we would have to capitalize the cost of that engine, and we would have to recover the cost over time via depreciation. Okay, and so if it's not clear, that's always the rule that you need to look at. Is it routine in nature, bringing it back to its original condition? If yes, go ahead and deduct it. If it's not, okay, if it's improving or extending the life of an asset, then we should be capitalizing that cost and depreciating it as a separate asset. Okay. So now we've talked about, when we have to capitalize an asset and when we'll be dealing with depreciation. So once we know that it's something we have to capitalize, it's going to benefit us more than a year, we have to deal with depreciation. The first thing we need to talk about is basis. Okay, you need to understand basis. And you need to understand 3 different types of basis. Okay, so let's start with cost basis because it's the easiest type of basis to consider. Cost basis is simply the purchase price, the initial cost of the asset. And to that purchase price, we're going to add all of the cost of getting the asset to our location and ready to use in our business. Okay, so to the initial purchase price, we're going to add any sales tax that we paid, any shipping costs to get the asset to our location, installation fees. We're going to add up all of this stuff, and it's going to be our cost basis. Okay, the next basis you need to understand is tax basis. So tax basis is when we purchase an asset, it's the amount of the cost that we haven't yet taken a tax deduction for, okay, and that's going to be our tax basis. And oftentimes, cost basis and tax basis are going to be the same, okay, so oftentimes these 2 bases are going to be the same amount, but not always, and I'll talk about when it's going to be different, when cost basis is going to be different than tax basis, okay, but tax basis is, again, the amount of the cost that we haven't yet gotten a deduction for. So once we purchase something and we establish that asset's tax basis, then we get to start taking depreciation deductions for that cost. And we're going to start taking depreciation deductions once we begin using the asset, or the term that tax people say is when we place that asset into service. Once it's placed into service, then we start recovering the cost via depreciation deductions. Okay. The last type of basis that you need to be aware of is adjusted basis. So once we begin taking depreciation deductions for an asset, then we have to reduce the basis in that asset by the amount that we've taken in depreciation. So adjusted basis is going to be the asset's original basis minus the depreciation deductions that we're taking. Okay, so adjusted basis is a running total of what we haven't yet taken in depreciation deductions. Okay, so it's important to do this right, and it's important to always know what the asset's appropriate or correct adjusted basis is, because if we happen to sell that asset, then the adjusted basis is important when we determine the gain or loss that we incur when we sell the asset. Okay, when we sell something, the gain or losses are amount realized minus our adjusted basis, right? So it's important to get the adjusted basis correct. And again, the adjusted basis is the running total, what we start with, our original cost basis or tax basis. We're going to, every time we take a depreciation deduction, we're going to reduce our basis by the amount of the deduction we've already taken, and this is the assets adjusted basis. Okay. All right, so here's some special basis issues, things to keep in mind. Typically, when we buy something, our basis is the purchase price, right, what we paid for it. But here, this slide goes over 3 examples of when our basis is not going to simply be the amount we paid for it. So the first special issue or special circumstance that you should be aware of is if someone gives you property as a gift. So let's just look at the example. Your grandfather gives you a gift of property with a fair market value of $100,000. That's what it's worth. If you went out and sold it, someone would pay you $100,000 for it. Your grandfather's basis in that property is $30,000. If he gives you this property as a gift, then your basis in the property is going to be the same as your grandfather's basis in the property when your grandfather gives you the gift, okay? So if it's a gift, your basis is the same basis as the giver's basis, okay? So if it's a gift, your basis becomes $30,000. If you went and sold that property the next day, you would have a taxable gain of $70,000, right? You could sell it for $100,000, your basis is $30,000. Another important thing is if your grandfather gives you this property and you start to use it in your business, then the amount that you can take in depreciation deductions is going to be limited to $30,000. Okay, that's going to be your basis that we use to determine how much depreciation expense you can take. So as you depreciate the kind of the cost of this asset that's now used in your business, your deductions are going to be based on a $30,000 basis, and that's the maximum amount that you're going to be able to take in depreciation deductions if you then use this property in your business. Okay, the rules are different if you receive property as an inheritance. And so let's look at this example. This time your grandfather dies and leaves you this property in his will. So this is different than a gift. A gift happens during someone's lifetime. An inheritance happens when that person passes away and you receive the property via their will. And so in this situation, your basis in the property becomes the fair market value of the property on the date of the giver's death. Okay, so your grandfather leaves you property worth $100,000. Your basis in that property is going to be $100,000, the value of that property on the date of his death, even though his basis was only $30,000. Okay, you get a step up in basis if you receive something as an inheritance. Okay, so your basis is different if it's a gift versus if it's an inheritance. Okay, and then the final special issue that we should be aware of is if you have assets that you were using for personal purposes and you begin using those assets in your business. Okay, so you convert personal use assets to business assets. We have to figure out what is the basis of these assets in our business. In this scenario, the basis in your assets is going to be the lesser of the cost basis of the asset, what you purchased that asset for, or the fair market value of the asset on the day that you converted it from personal use to business use. Okay, so if you start a business and your business asset, you're taking your personal assets and turning them into business assets, again, we have to figure out what is the basis, how much can we depreciate now that they're business assets, and your basis is the lesser of the cost or the fair market value on the date that they're now business assets. Okay, all right, so now let's start talking about depreciation. So we know what we have to capitalize. Okay, we know if it's going to provide a benefit for longer than a year, we have to capitalize it and we're going to recover it via depreciation. And we talked about basis, right? So our depreciation deductions are going to be based on the basis in our property, and we talked about how we figure out what our basis is. So now let's talk about, now we know what the basis is, how much deduction do we get to take via depreciation rules. So this slide is just a little bit of a history lesson. Before 1981, tax depreciation was calculated very similarly to financial accounting depreciation, where the taxpayer got to determine the useful life, the taxpayer got to determine any salvage value, and this is how we used to do it. This caused a lot of problems because, again, what is the objective of the taxpayer? To minimize current year taxable income. So taxpayers often try to use very short useful lives, trying to accelerate the deductions into earlier years, where the IRS, their objective is to prevent taxpayers from kind of manipulating the system. And so oftentimes there were fights over the useful life, with the taxpayer wanting very short lives, the IRS arguing for longer lives. Okay, so this caused a lot of problems. So in 1981, Congress passed a law creating ACRES, the Accelerated Cost Recovery System. We used that system for a while, but then they modified the system. The system that we use today for tax purposes is the Modified Accelerated Cost Recovery System. And if you're a tax person, you call this MAKERS. Okay, we call it MAKERS for short. So we're going to use MAKERS depreciation again to deduct the cost of personal property and real property. When I talk personal property, I'm talking anything that's not real property that's used in our business or for investment purposes. So when I say personal property, please don't think personal use property like your home or your car or your boat. In general, you don't get depreciation deductions for these things. We did our individual class last semester, and you learned that most personal expenses are non-deductible in the tax return. So when I say personal property, I'm not talking personal use assets. Personal property is simply anything that's not real property, okay? And so the slide, automobiles, computers, furniture, equipment, this is all personal property. We're also going to use MAKERS to depreciate real property, but please keep in mind, okay, this is very important, we never depreciate land. If we purchase land, the only way we recover the cost of that land is when we sell it, okay? Then we get to reduce our amount realized by the basis in the land, and that's how we recover the cost. We never ever depreciate land, but we do depreciate buildings, and we use MAKERS to calculate the depreciation deductions for buildings. Okay, so to calculate MAKERS or tax depreciation, we need to know the following. We need to know the tax basis, we talked about that. We need to know the recovery period, the depreciation method, and the convention. So I have slides that cover all of these, but these are the 4 things you need to know, okay? And again, we already talked tax basis, so let's jump right into the recovery period. Okay, so you need to know the recovery period of the asset. So just comparing financial accounting to tax accounting, for financial accounting, the taxpayer gets to determine the recovery period, and we call it the useful life, right? So the taxpayer gets to decide how long that asset is going to be useful to them in their business, and they get to decide. Well, for tax purposes, taxpayers don't get to decide, okay? So for tax, we have to use predetermined recovery periods, and the IRS provides these predetermined recovery periods in something called Rev Proc 87-56. Don't worry about remembering the number of that revenue procedure. Just remember that for tax, the taxpayer doesn't get to decide what the useful life is. The IRS tells us what useful life or recovery period we have to use, okay? So taxpayers have no choice on their tax return. They have to do what they're told, okay? There are 10 possible recovery periods, and we'll look at a depreciation table in a second, and it'll pull everything together, hopefully. But there are 10 possibilities when we're looking at recovery period. And this is important too. The recovery period is going to be the same whether we purchase a new asset or a used asset. So let's say we need a new truck for our business. If we purchase a new truck, the recovery period is 5 years. If we purchase a used truck, the recovery period is also 5 years. Again, taxpayers get no say in this. You buy a used truck, you're pretty sure that truck is only going to last you 3 years. On the tax return, it does not matter. You have to use a 5-year recovery period and spread the cost over 5 years. Okay, so the IRS tells us what the recovery period is. Again, on the exam, I'm going to tell you what the recovery period is, so you'll always have the recovery period. Your homework, you might have to determine what the recovery period is, and this table, most assets that we use in a business are either going to be 5-year assets or 7-year assets, and so this exhibit just tells you which are 5 and which are 7. So you might need this table for the homework, but for the exam, I will tell you the taxpayer purchased a 5-year asset or it's a 7-year asset. You'll know what the recovery period is. Okay, so again, recovery period, we're done with that discussion. It's not a very difficult concept because the IRS tells us what the recovery period is. So what you should remember is the IRS tells us, the taxpayer has no say in the matter. Okay, so then we need to talk about depreciation methods. So there are 3 acceptable methods to use for tax depreciation, okay? And oftentimes the method that you use is a function of the recovery period. So most of the time, if you know the recovery period, which I will tell you, then you automatically know the depreciation method, okay? So let's talk about the 3. So the first type is 200% double declining balance. In general, this is twice the amount of depreciation that would be allowed under the straight line method. That's why we call it an accelerated method for tax purposes. You get more than what's allowed under straight line, okay? So the 200% in general is about twice what you would get under the straight line method. and we're going to use this method for assets with a 3, 5, 7, or 10-year recovery period. Okay, so most of the time we're using a 5 or 7-year recovery period, and because it's 5 or 7, you know automatically that we're going to use the 200% declining balance method. There's also a 150% declining balance method. Generally speaking, this is 1.5 times what you would get under the straight line method, and we're going to use this method for assets with a recovery period of 15 or 20 years. And finally, we have straight line depreciation. This is very similar to what you do in financial accounting. We're going to use straight line depreciation for all real property, except remember that we can never depreciate land. And then if a taxpayer wanted to choose to use straight line instead of 200% or 150%, the taxpayer could do that. They could opt to use straight line instead of one of these other methods. But most taxpayers aren't going to do this because it's going to result in less depreciation early on. Okay, so the 200%, the 150% methods allow the taxpayer to accelerate deductions into earlier years. Okay, so usually this is preferred by taxpayers over straight line. But if they want to use straight line, they can make that election and go ahead and use straight line. Okay, and so that's depreciation method. And again, we're not going to talk any more about it because most of the time it's a function of the recovery period, and the recovery period is easy because the IRS tells you which recovery period to use. Okay, so this slide just talks about or just highlights the fact that tax depreciation is usually different than GAAP or book depreciation. Okay, why is it different? Because oftentimes the recovery period is different. For book purposes, you get to choose a useful life. For tax purposes, the IRS tells you the recovery period that you have to use. Okay, so that's one reason why the number is oftentimes different, the recovery period is different. The second reason that tax depreciation is oftentimes different than book depreciation is we're using a different method. For book purposes, we're using straight line depreciation most of the time, and most of the time we're using an accelerated method for tax depreciation. So what does this result in? Okay, so the result of these differences is that for tax purposes, we usually get more depreciation in the early years of the asset. Okay, so in year 1 and 2 of the asset's useful life, oftentimes the tax depreciation that we get to take is more than the book depreciation that you get to take on your GAAP financial statements, but then it's going to switch, and in the later years of the recovery period, the tax depreciation that you get to take is going to be less than the book depreciation. Okay, so in any given year, your tax deduction is going to be different than your book deduction. Tax deduction will be more in the early years, book deduction will be more in the later years. But remember, for both book and tax, at the end of that asset's useful life or at the end of the recovery period, regardless if you're looking at tax or GAAP, you will have taken deductions equal to the total cost of the asset. Okay, so the difference between tax depreciation and book depreciation are timing differences. It's not a difference in the total depreciation you get to take, it's just a difference in when you get to take those deductions. Okay. All right, so the final thing that we need to understand for tax depreciation is the depreciation convention. And what the depreciation convention tells us is essentially how much depreciation do we get to take in the first year. Okay, we purchase the asset, how many months of depreciation do we get to take in year 1? Okay, and so oftentimes we're going to use the half-year convention. Okay, and the half-year convention allows us to take 6 months of depreciation in the first year and 6 months of depreciation in the last year, okay, using the half-year convention. This is regardless of when the asset is actually purchased and placed into service. So this means if a taxpayer purchases an asset on January 1st, the taxpayer gets 6 months of depreciation for that asset in year 1. If the taxpayer purchases an asset on December 31st, the taxpayer also gets 6 months of depreciation for that asset. So if we're using the half-year convention, every asset in the year of purchase, the taxpayer gets to deduct 6 months of depreciation in the year of purchase, okay, regardless of the actual purchase date. The IRS provides tables for us to calculate depreciation. So it's actually, if you're feeling overwhelmed or if you think this sounds complicated, I'm going to show you the table, and hopefully you'll realize that it's quite easy actually to calculate the proper amount of depreciation. So for this half-year convention, if you just get to take half in the first year and half in the last year, the IRS makes this very easy on us because they provide us tables with percentages to use, and these tables already account for the fact that we get 6 months in the first year and 6 months in the last year. Now, the one thing we have to remember is, let's say we buy a truck, okay, and the truck is a 5-year recovery asset, okay, so we're going to recover the cost over it's a 5-year recovery. So what this half-year convention means is, if we buy a truck and it has a recovery period of 5 years, we're actually going to get 6 years of depreciation to recover the cost of that truck. Why? If we buy the truck in 2014, we get 6 months of depreciation in 2014, and then for the next 4 years, we get a full year's worth of depreciation, and then in that 6th year, we get the last 6 months of depreciation. Okay, so this is automatically built into the tables. This is why a 5-year asset is actually going to be depreciated over a 6-year period of time. Something that we have to keep in mind is, if we buy a truck in 2014 and we sell it in 2017, that would be year 3. We still get 6 months of depreciation in the year that the asset is sold, okay? So 6 months in the year of the sale. But if we sell it before the end of the recovery period, then we need to do a separate calculation to calculate depreciation for that asset, okay? And we'll go over an example. We'll go over lots of examples in class, okay? So typically it's built into the table. Unless you sell it before the end of the asset's recovery period, then you have to do a separate calculation to get the depreciation right. Okay, so this is what the depreciation tables look like. This is how the IRS makes it easy on us, okay? So again, most of the assets that you're going to deal with are going to be 5-year assets or 7-year assets. This table simply tells you, you start with the original cost of the asset, okay? So we buy a truck for $100,000. The truck is a 5-year asset. In the first year, the year that we buy it, we get 20% of $100,000. So this is a percent of the original price that we get to take as a deduction. So in the first year, our depreciation deduction is $20,000. In the second year, we take the original cost, again, $100,000. This time we take it times 32%, and so our depreciation deduction for year 2 is going to be $32,000. Okay, so you're going to be told what the recovery period is. If it's the half-year convention, then we're going to use the same table for every asset that we purchase, and this table is going to tell us what the percent depreciation we get in each year. Okay, so here's the truck. This would be 2014, 2015, 2016. Over here are the years, as many years as the recovery period is. And so down here in year 6, that would be the last year we'd get a deduction for our truck that has a 5-year recovery period. Again, why do we spread it out over 6 years? Because this 20% represents 6 months of depreciation in year 1, and this 5.76% represents 6 months of depreciation in year 6. Okay, so that's why a 5-year asset is actually depreciated over 6 years. In the first year we get 6 months, in the last year we get 6 months, already built into the table, already built into these percentages. In these middle years we get a full year's worth of depreciation. Okay, so again, this is what the table looks like. The half-year convention, pretty easy. All 5-year assets in the first year, you're taking 20%. All 7-year assets in the first year, you're taking 14.29%. Okay. So again, this just kind of goes over, hints for using the depreciation tables. Always use the original tax basis to calculate depreciation. So this is just going to walk you through, let's say we buy a truck for $20,000. As you're applying the percentages from the table, always use the original basis of $20,000, okay? Don't reduce the basis by the 20% you took in year 1 when you go into year 2. Do not do that, okay? Just always use the original basis. Always use the percent that you pull from the table, okay? Remember that the half-year convention is already built into this 20%, so do not, for the first year depreciation, take 20,000 times 20% and then divide it by 2 because you only get 6 months. Do not do that, because the 6 months is already factored into the 20% that the table provides, okay? But also recall that if you sell the asset before it's fully recovered, then the table isn't going to factor in 6 months of depreciation, okay? So remember, in the year of purchase, you get 6 months, and the last year that you own the asset, you get 6 months. So let's look at this example. Down here, if the taxpayer sold the truck in year 3, okay, so how are we going to calculate depreciation in year 3? $20,000 times 19.2%. So that would be the year 3 deduction if we did not sell the truck, okay, if we owned the truck for the entire year 3. But this example is telling us that we sell the truck during year 3. We get 6 months of depreciation in the year of sale. We always get 6 months of depreciation in the last year that we own the asset. So to calculate depreciation in year 3, if we sold the asset, we have to take the amount that we calculate from the table and then take it times 50%. Okay, we only get 6 months. And again, in the year of sale, it doesn't matter if we sell the asset on January 1st or December 31st. The year of the sale, we always get 6 months. So we're always taking it times 50% of what it tells us from the table. Okay, so that's the half year convention. Okay, pretty easy. Okay, we're always going back to this table, just pulling the percentages. The only thing you need to remember is if you sell the asset during the recovery period, you have to take the depreciation that you calculate times 50% to get the correct amount of depreciation. Okay, the last thing we need to discuss is the mid-year convention. So again, I said the half-year convention is what we use most of the time. This slide tells us when we might have to use the mid-quarter convention. Okay, this is a separate type of convention. Again, the convention is simply telling us how much depreciation do we get in the first year and how much depreciation do we get in the last year. Under the mid-quarter convention, if we have to use it, we're going to assume that instead of getting 6 months of depreciation in the year of purchase, we're going to assume that we place the asset into service in the middle of the quarter that it was purchased. Okay, so if we have to use the mid-quarter convention, we can't assume 6 months of depreciation in the first year for all of our assets. Our assets are going to be different depending on when we purchase the asset and place it into service. Okay, so when do we have to use the mid-quarter convention? We have to use it when 40% of our assets were purchased in the last quarter of the year. So for most taxpayers, if we're looking at a calendar year, this is October, November, and December. Okay, so how we're going to figure out if we purchase more than 40% of our assets in the last quarter is we're just going to add up the cost of everything we bought in October, November, December, and we're going to divide that by the total cost of what we purchased for the entire year. And if this quotient, okay, if this amount is more than 40%, then we have to use the mid-quarter convention instead of the half-year convention. Okay, so take fourth quarter purchases divided by total purchases. If this amount is more than 40%, then you're stuck with the mid-quarter convention. Okay, a bummer for a couple of reasons. It's a little bit more complicated of an analysis. And then also why it's kind of a bummer if you have to use a mid-quarter convention is you're getting less depreciation, okay, early on. In the first year, you're getting less depreciation if you have to use the mid-quarter convention than if you were using the half-year convention, okay? So again, the mid-quarter convention treats each asset as if it were placed into service halfway through the quarter. So what does this mean? For any asset that we purchase between January 1st and March 31st, we're going to assume that we actually bought and placed that asset into service on February 15th, and the mid-quarter convention, instead of allowing 6 months of depreciation in the first year, we're going to get 10.5 months of depreciation in the first year, okay? So the half-year convention assumes we place everything into service right in the middle of the year. The mid-quarter convention assumes that we place it into service in the middle of the quarter in which it was purchased. So anything purchased in the first quarter, we're going to assume a February 15th date, and we're going to take 10.5 months of depreciation in the first year. Anything in the second quarter, we're going to assume we place it into service on May 15th, and we're going to get 7.5 months of depreciation in the first year, and so on, okay? And so here, let's look at the tables. So if you're using the mid-quarter depreciation convention, then you can't just use one table. Recall the half-year convention table was one table that you would use for all assets. If we're using the mid-quarter convention, then there are going to be separate tables depending on the quarter in which you placed your asset into service. Okay, so you'll see first quarter, second quarter, third quarter, fourth quarter. So if you have a 5-year asset that you purchased in January and you're using the mid-quarter convention, then your first year depreciation percent is going to be 35%. If you bought an asset in the same year in November in the fourth quarter and it was a 5-year asset, then the amount of depreciation you get in year 1 is only 5%, okay? So the mid-year convention, we use one table for everything. If we have to use the mid-quarter convention, we have to use different tables, and the table that you're going to use depends on which quarter you purchased the asset. If you purchased it in the first quarter, you're going to use these percentages. Second quarter, you're going to use these percentages, and so on, okay? And just as a comparison, if you go back and look at the half-year convention table, if we have a 5-year asset, the first year's percent is 20%. And so if you look here, if you have to use the mid-quarter convention, in the first year, if you purchased an asset in the first quarter, you're actually going to get more depreciation using the mid-quarter convention. You get 35% instead of 20%. But if you come and look at the fourth quarter, you're getting significantly less depreciation if you have to use the mid-quarter convention. So if you have to use the mid-quarter convention, instead of the 20% we see in the half-year table, you only get 5% if you have to use the mid-quarter tables, okay? And so this is why you're going to get less depreciation overall if you have to use the mid-quarter convention, because most of your assets were purchased in the fourth quarter. That's why we have to use the mid-quarter tables, because everything was purchased at the end of the year. And so for most of your assets, you're using these percentages, which are much less than if you use the half-year convention table, okay? All right, so those are depreciation conventions. If it seems kind of confusing, I promise we will clear it up in class with a lot of examples. So just kind of convention, what it boils down to, there are two types, right? There is the half-year convention and there is the mid-quarter convention. Most of the time we get to use the half-year. We would prefer to use the half-year because it's easier. We use one table instead of four tables. When we have to use the mid-quarter table is when more than 40% of our assets were purchased in the fourth quarter. Then we're stuck using these tables, and we'll go over examples in class. Okay. So the final slide is looking at depreciating real property. So for real property, we still call it makers. We still say we're depreciating it using an accelerated system, but we're actually not. Okay. So for real property, we're going to use the straight line method, and we're going to use something called the mid-month convention. What does that mean? It means that if we buy a building, if we bought it in March 1st, we're going to assume that we place it into service on March 15th, okay? The same thing if we bought it on March 31st, we're going to assume March 15th. So we're going to place it into service in the middle of the month of the purchase, okay? So that's what the mid-month convention means, and we're going to depreciate it using the straight line method. So look in the appendix to Chapter 9, specifically tables 3 and 5. Have these tables handy in class because we'll go over examples of how we calculate depreciation for real property, and it will be good for you to kind of have these charts right in front of you so you can see where the numbers come from, okay? But we'll go over examples of real property in class, and it's pretty easy because essentially we're using the straight line method, which you're already familiar with, okay? One thing that you should be familiar with in terms of real property is the life of the property, okay, the recovery period is going to depend on whether it's residential, if someone's living in the property. If someone's living in the property, then the recovery period we're going to use is 27.5 years. If someone is not living in the property, if it's non-residential, then the recovery period is 31.5 years. Okay, or excuse me, 39 years. So on this table, if the asset was placed into service after May 13th of 1993, which for you, this is we're in 2015, right? So any asset that we place into service is going to be after this May date. I'm sorry. But so the recovery period, you can ignore this last recovery period, ignore the 31.5 years because we don't see that anymore. The recovery periods that you should be concerned about are 27.5 or 39 years, okay? 27.5 if someone's living in the property, if it's an apartment building, a duplex, 27.5. If it's not, if it's a warehouse or an office building, then the recovery period we're going to use is 39 years, okay? And again, when we get together in class, we'll look at these tables and go through a lot of examples and hopefully clear up any questions you might have about depreciation.